Alrighty, hello everyone, and welcome to TradeFinder Live. It's great to be back with you all during this trading day and during trading hours. First and foremost, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like. That's the main point to take away. Other than that, we have the Fed decision in progress and lots of anticipation around what that outcome is going to look like, whether it's 25 basis points, 50 basis points, no basis points. We'll find out here shortly, and the implications after will be interesting to monitor. So, of course, excited to get into that discussion with Rob and very excited to interact with you all. So let's go ahead and kick off. Rob, you out there?
I am Zack. Hey, everyone. Welcome to TradeFinder Live. I would like to echo the sentiments that you mentioned there at the beginning, Zack. We are here finally. Gosh, Zack, how long have we been talking about this September Fed meeting? Ever since the July meeting, right? We've been pointing towards September and what was going to happen. And you talked about potentially no rate cut. I really think the Fed goes 25. That's my opinion for whatever it's worth, which is not much. There are whispers out there of 50 basis points. And this morning, there was one Fed governor that would go along with the administration, where there was an administrative official that urged 75 basis points. I think that's a pipe dream. I don't think that happens. I'm not sure that Chairman Powell would go 50 basis points because he's been so adamant about waiting and reluctant to cut rates. Even a 50 basis point rate cut, I think, kind of shows that he's been wrong. And none of us like to admit when we're wrong. We all know we're going to be wrong, but nobody likes to admit that we're wrong. And I just cannot see the Federal Reserve going 50 basis points. I may be wrong. Maybe they do. I think we get 25 basis points, and then after the announcement, it's going to be what's the guidance going forward. Just like when a company comes out and reports quarterly earnings, the earnings are important, but that's the previous quarter. What are they guiding towards the next quarter? You saw that with Oracle. Oracle's numbers came out very much in line. I can show you the chart, and then it probably would have sold off, but they gave really surprising guidance for the next quarter. And then we had exactly what we talked about. We talked about this last week in some of our live shows with our subscribers at evotrader.com. Anytime we get one of these big gap up vertical moves, separation from the 10-day moving average, you get about a 1 to 3 day pullback. And in this case, it was 2 days. So right in that window where you can quickly short, but don't stay in the short position, these ginormous moves. But it's just important to note that this big gap up was because of the guidance, not because of the earnings report that came out. What happens with the Fed meeting tomorrow? What do they do? And how does the market react? I think, again, my opinion, take it for whatever it's worth, is that if the Fed only goes 25 basis points, even if they admit that, okay, we're changing policy, we're moving towards a more easing policy, but they don't give any details about, all right, we'll probably do again in December, whatever, because the market has 75 basis points priced in. That's the important thing that you need to know. The market is priced in 75 basis points of rate cuts between now and the end of the year. And if the Fed doesn't at least, guide towards that number, I think there's a chance the market reacts poorly to this news. And so if we take a look at this, and by the way, thanks everybody. Over the weekend, the U.S. market update finally got us to that big round number of 50,000 subscribers on our YouTube channel. We've been looking for that for the past couple of weeks. We finally hit it, and much appreciation to those of you that watched that and have joined TradeFinder from viewing our U.S. market updates each and every week. Very much appreciated. And we talked about over the last 2 weeks a special offer for Top Shot. You can go to our website and look at the offer for Top Shot, which is basically the cherry pick of our 4 primary strategies at ewotrader.com, and you get one alert each and every week. It's only $99 for the entire year. And we just closed out a trade today that doubled that. And you were at 26 times what you would have paid for Top Shot going back to inception in April. Anyway, let's get back to looking at the market. And you can see that with this move higher, there's several things to talk about here. First of all, we are still in an active wave 3. And as a reminder, for those of you that might be newer viewers, and every now and then we get a comment on the US market update each and every week that you don't agree with where my Elliott Wave labelings are, I just want to emphasize the fact these are not my Elliott Wave labelings. I don't come in and label the Elliott Wave numbers. The algorithm does it in the Hub software, hubb.com, where you can get the software and the Elliott Wave counts for free. And the Elliott Wave counts are derived from the software exactly as the algorithm was written by Ralph Nelson Elliott over 100 years ago. So I'm not labeling those. Now, I do manually draw the zigzags. And so when we got up to here and the AI aspect of the Hub platform, which the software is free, Elliott Wave signals are free. You can subscribe to the AI signals if you choose, but that's a personal choice of yours, just like Top Shot would be a personal choice. But you get the charting platform and the social media aspect. Zack will come in a little bit later on and show you all for free. So back in June, the AI gave us a 62% chance, so better than a toss of a coin, that we'd hit 652. It took us a while, but we got there. So we finally hit 652. So then the question that came up 2 weeks ago on the US market update is, okay, we hit that level. Now where do we go? All right. I had the same question. What's the next likely target? And there was a zigzag right here within the wave 3. It's not the only one. I could go back and draw several of them, but we're trying to figure out where the next likely move was currently. And so the latest zigzag had us going to 660. That's where the 100% extension was. We had a perfect 50% correction in the B wave. That leads to the expectation of 100% extension on the C wave. And we're there. We got there yesterday. Pardon me. And we're just kind of trading there at this point in time. There is a little separation from the 10-day moving average. That's the lime green line. And as a reminder, one of my trading rules is no security in any time frame gets very far from the 10-day moving average, at least not for long. There can be separation, but it doesn't last very long. Eventually, whatever security you're trading and whatever time frame you're trading it in is going to come back to that 10-day moving average. So we're a little bit above it, and we've hit that 100% extension. Now, there is a potential for an extended C wave. And if we go past 100%, I have 138.2 on here because it is a fib level, but I don't pay much attention to it. The next big fib level that I will look at is 161.8. And that is a possibility, as is the thing that I've been wondering about. If we don't get 50 basis points tomorrow, which I think the Fed would really like, do we have a buy the rumor, sell the news? Is the market actually a little disappointed in a 25 basis point rate cut and we start the wave 4 correction? I think it would be foolish not to at least embrace that possibility out of whatever happens tomorrow. And whatever happens after the Fed meeting is likely going to have some volatility, not just tomorrow afternoon, but Thursday as well. And we probably won't know till the end of trading on Thursday how the market actually views this, because the initial reaction on a Fed meeting is likely retraced in the next trading day. So I think the easiest trade is that we get a 50 basis point rate cut, the market goes crazy, and we get a big spike up on that. And we get a lot of that retail money that we all know is sitting in mutual funds to come into the market. We get a big spike up, and that's the FOMO. That is that last move of the retail traders that have been hanging on, waiting. They come in, and then that's when we can go short and look for a bit of a corrective move. even if that doesn't happen, we're still a little separated from the 10-day moving average. So one could argue that a little bit of pullback on the Fed announcement tomorrow, regardless of what it is, and nobody knows exactly what they're going to say, to my knowledge. Uh, we could get at least a correction back to this 650 area here, somewhere in that area that coincides with the previous AI target at 652, and maybe even down to that A wave top there, a little bit below the 10-day moving average. Maybe we come back to it. Maybe we go but a little bit below it. But I would not be surprised to see some sort of a market corrective move following that, barring a surprise move. Again, that could create the FOMO thing where we get the spike up. If we get a spike up higher after a big run like this, I do think that's an ideal place to short. The market doesn't always give you the ideal scenario. In fact, it rarely gives you the ideal scenario. But I think those are all things that we need to be watching for as the Fed now, I was going to say hopefully changes course. Let's talk about what happens if they don't do anything tomorrow. I think that is a significant downward move. The market, again, has priced in 75 basis points between now and the end of the year. And some people are looking at 25 basis points. Some people are looking at 50 in the move tomorrow, in the meeting results tomorrow. If they give us nothing, I think you see a big downdraft in the market, not just a little bit of a wave four correction. I think all of that move that I've talked about, possibly even back down to here, the royal blue line at the 50-day moving average, occurs in one day. I think it could be really, really ugly tomorrow if the Fed stays hawkish and doesn't give any sort of a rate cut, even if they come out. Now, that's when I don't think the commentary would matter. If they don't cut at this meeting, even if they say, but we're looking at cutting at the end of the year, I think the market's tired of that. They dealt with that in July, and they kind of went sideways. So they absorbed it in July. I don't think the same thing happens if that occurs at the September meeting. Anyway, those are my opinions on where we could go from here on the SPY. So even if we get that spike up, I think you have to watch that 675 level as resistance. So it wouldn't be a tremendously huge spike up, but higher from where we are here. And then I think that's the easiest short you've ever seen, unless you could foresee the pandemic coming, which we kind of did going back to our market outlook before 2020. But that's 5 years old, so that doesn't matter anymore. Let's go ahead and take a look at the bond market, because that's where a lot of people are going to be looking to see what the bond market is showing. And with this breakout move, now we did have a triangle, and I've shown you this before multiple times if you've watched TradeFinder or you watched the U.S. market updates, going all the way back to the lows that occurred back in early 2025. The bond market has been as indecisive as I've ever seen it, where we've had some breakout moves of these triangles, but in the end, not much has gone on. 1, 2, 3, 4 triangles. We broke out. And then if you take a look at it, you can see that with this upward move in TLT, as a reminder, TLT is prices on the 20-year bond. Prices and yields move inversely. So when you see prices going up, that means yields and rates are coming down. And to see such a vertical breakout move, to me, says that the bond market is pricing in a strong potential of a 50 basis point rate cut. Now, whether or not the bond market's right or not, we'll find out tomorrow at 2 o'clock. But I just don't see this kind of a breakout move on a 25 basis point rate cut. I think the bond market is saying there's a chance, and there's a reasonable chance they might go 50. We'll see. The bond market's pretty smart. There's a lot of smart traders in the bond market, and the reason we show bonds is because there's more money in the bond market than there is in the equities market. And the equities market oftentimes takes a cue from what occurs in the equities market oftentimes takes its cues from what occurs in the bond market. So here's the 10-year. on TNX, and TNX does actually show rates. So that's why you see them opposite. You saw prices going up on the 20-year. That means yields and rates are coming down. When we look at TNX, that's rates on the 10-year, and it shows rates coming down. And we're in an active wave three. The three is still green, which means we could go lower in rates. But what you're seeing here, what the bond market is showing you, is rates going down across the yield curve. And that sounds good at first blush. But what we really want is a steepening yield curve. If you believe in the fact that the economy is okay and you want to see reflections of the fact that we're all right in the economy, we know the jobs market is weakening. We've had enough data to show that with the JOLTS report, the ADP report, the non-farm payrolls report, the CPI report with its employment component in it. A plethora of data showing us the bond market is weakening. And that's why the bond market is pricing in a rate cut, because the Fed has said they're watching the employment situation, the jobs market, quite closely, and they're taking them at their word, which, at your own peril, do that, I think. But what you would prefer to see is not as much of a move lower in rates on the long end of the curve, more on the short end of the curve. And as you can see, it's kind of the opposite. So there's the 10-year. Rates have come down, no doubt. But if I go back to the 20-year, you can see how vertical this moved up. So the yield curve is not steepening. And what that means is that when you're looking at buying a bond or a treasury, common sense, even aside from the fact of how the bond market works, is that you should earn a higher interest for holding a bond or treasury longer. So when you're getting roughly the same interest rate for holding a 2-year, even you can go down to 3 and 6 month treasury bills, T-bills. But when you're getting roughly the same interest on a short maturity as you are on a long maturity, when you're committing to holding something 20 or 30 years, that tells you something's wrong. That, even just without knowing anything about the bond market, that's not a common sense type of a reaction. So when you have a steepening yield curve, that means yields and rates are lower on the shorter end of the curve and yields and rates are higher on the longer end of the curve. And we've had rates coming down across the curve. It's not inverted anymore, which historically has given signals of a recession. The economy is not showing signs of recession, even though it is slowing. But it's also not showing a sign of economic strength either. So that's why we've seen so many triangles in the bond market. It's kind of in between. And when we go back on the TNX, you can see the same 4 triangles. So you look at the 10-year, shorter end of the curve, the 20-year, moving towards the longer end of the curve, all kind of the same, which tells you we have basically what's known as a flat yield curve, which means rates are pretty consistent, whether you're going shorter term or longer term in duration. And that's, again, not how it should be. So we are not all clear in the market, even with the Fed moving into an easing cycle. You hear a lot of commentary on the financial markets of, oh, we've got a decent economy and we're going to be moving into an easing monetary policy. The market should take off. Not quite in that camp. I think that's a possibility, but very short-lived, as perhaps some of that retail money in money market accounts comes piling in with that FOMO that I've been talking about, the retail trader that's been holding off, waiting for the corrective move that hasn't come, and you get the big spike up and they throw in the towel and they come in the market. And then when the last retail traders come in, that's normally when you get a corrective move. But I do want to be clear on this, going back to the chart of the SPY. I'm in no way calling for any sort of a crash in the market, as some people are, or a massive breakdown, just a healthy wave 4 correction, which will start at some point in time. If that wave 3 holds, the next move is a wave 4. It's a wave 3 to the upside, you'll have a wave 4 lower. That's what I'm looking for, not any sort of a collapse out of the markets or economy, just a normal, healthy wave 4 correction. If we take a look at the dollar, still stubbornly, but being very constructive towards equities, staying in this Goldilocks channel that I've been calling this down here. That's been my labeling for this sideways channel the dollar's been in. And I call it Goldilocks because it's a lower dollar. It helps companies with international exposure, which most do these days. We have a global economy across the entire world at this point. And when the dollar is lower, that helps companies with international exposure from the exchange rate. We haven't had a big bounce up going all the way back to July, but do we have a significant breakdown on a rate cut? I think if the Fed goes 50 basis points, you do see a big move down in the dollar. Not sure what will happen on 25 basis points because that's kind of priced in. And I feel like a little bit of a move down in the dollar on any sort of Fed easing would be okay as long as we don't take out this wave 5 low. That's what I'm going to be watching for. If the dollar breaks this 97.5 level, which it's tried to a few times here over the last couple of months, even if it breaks that, but can hold this wave 5 low from the beginning of July, I think we're okay with the dollar. What I don't want to see personally, again, if you've been listening, you've heard me say this numerous times. I repeat myself a lot in these because we add new people all the time. Some of you are like, God, I've heard him say this 100 times. Other people are hearing it for the first time. So I appreciate the patience for those of you that join week in and week out so that the newer people can catch up. I don't want to see the dollar break that wave 5 low. I don't want to see it come down to this wave 5 target because then I think it brings in a whole new set of concerns on whether or not other countries will continue to hold our dollars. Will they dump the dollar? Will they be tired of losing money on holding dollars? Or will the dollar somehow remain as the de facto currency of last resort? That's what we want. And you know, just watch and see. I don't want to see all that whispering come out because that kind of stuff, especially in the world of social media that we have now, can create a lot of fear mongering very quickly, and it can create some significant problems. So, in my opinion, once again, for whatever it's worth, is that if the dollar comes collapsing down, that creates a whole new set of concerns that the equities market is going to have to worry about. For now, it's been great. Staying in this Goldilocks channel, it's been helpful to the equities market. It's been supportive of the melt up that's occurred in the SPY. So we'll see. And then on the other side of the coin, if by chance the Fed stands pat and people are arguing, would it be political or would it be their true views? If they don't do anything tomorrow, I think you see a big spike up in the dollar and up to this level of resistance at 100. Once again, no big deal. Just like I said, a drop to the wave 5 low. I think the market handles that okay. A spike up to 100, I think is okay. But if we start to see the dollar take off and run with the viewpoint of it doesn't matter what the jobs market data shows until we get inflation down back under 2.5%, which it was at one point in time, and moving towards that 2% mandate that the Fed, which I think they didn't never really thought we would get down to 2. I think they've just been using that as an excuse on not to cut rates. But if we start seeing any sort of a potential rise in inflation, the whole world changes. Then we start looking at stagflation. So the dollar goes stronger, the inflation numbers stay stubbornly high, the jobs market weakens, meaning the economy weakens because we're a consumer-driven economy and people have to have jobs to spend money. Stagflation is the worst of all scenarios. It puts the Fed literally between a rock and a hard place. That old cliche you've heard for a million years is really where they would be, because what do you do? Do you raise rates into it because of inflation? Do you cut rates because the economy is weak? What do you do as the Federal Reserve? And they've made numerous mistakes over the decades, from that going all the way back to the 70s, where they cut rates into a higher inflationary area and interest rates went nuts. They went bonkers. And that's not good for the equities market at all. Now, that could be a longer term downward move in the markets. What I'm looking for is just a shorter term wave 4 correction. But if we start hearing stagflationary comments more than just a few whispers here and there, that leads to a longer term downward trend, which could take a while to get out of. So you can see what I've been going through here, the importance of what the Fed not only says tomorrow, what they do, But what is their viewpoint moving forward? So there's going to be a lot of dissecting in Chairman Powell's speech, and I've been talking about how the last few public appearances he's made. My viewpoint is he is so uncomfortable looking. He doesn't want to be there. He doesn't want to be answering all these questions. And my goodness, if they don't do anything tomorrow, I wouldn't be surprised. I'm just being facetious. He canceled the press conference because the commentary would be dramatic. But so we all need to see, and I think it's prudent to have some protection right now on your portfolio. If you're primarily long in your portfolio, having some protection, I think, makes an awful lot of sense. All right, let's take a look at the VIX, which every time it tries, can't get below 15. You know why it's ticking up now, because there is some volatility being priced in because of the importance of this Fed meeting tomorrow. So that little tick up is no big deal. But we just can't break 15. Maybe we do if the Fed goes 50 basis points and that money comes roaring in. Maybe we get a big move down in the VIX and we hit that 12 and a half level, which is where we spent last summer, but haven't really visited it since the end of last year. Haven't come down to that level at all this year. Maybe that gets us there. And then, of course, the scenario for a spike up in the VIX, because we do have this big descending triangle here on the VIX, would be a surprise that the Fed does nothing. You'll see, I think, a huge spike up in the VIX, probably at least testing this 22 and a half level. It's been a while since we've even drawn that, so I'd move that line over. I think you see the VIX at least go up there. But again, that's just what would happen in the unlikely scenario that the Fed doesn't cut. And then if we go take a look at what's going on in the other markets, if we look at the Dow, the DIA has been kind of hovering around the midpoint of this wave 5. Tap box stands for time and price projection, but that's the key. The Dow is still in a wave 5. If we go back to the SPY, as a reminder, it's in a wave 3. It's not unusual for the Dow and the S&P to have slightly different patterns, but it's unusual when they're not in sync. When you have an active wave 3, that means you could go higher. But when you have a wave 5 and you're in that tap box, that means the likelihood of a corrective phase following the run in the wave 5 is more likely than not. And then you look, how far was the wave 5? These are just very basic Elliott Wave rules that we have on our education area at ewotrader.com. If the wave 5 extends less than 100% on a corrective move, you look for a move back down to the previous 4. If the wave 5 extends more than 100%, you look for one of the fib levels on a corrective move, but you're not looking for a move all the way back to the previous 4. It might go there, but that isn't what your expectation is. So does the Dow relabel to a 3 if the Fed surprises and goes 25 basis or 50 basis points tomorrow? Maybe. And then we go look at the Qs, and you're going to see that we have split markets. The Qs are also in an active wave 3 with this move up, also a little separated from the 10-day moving average. So very similar to what's going on in the SPY, but not the same kind of pattern that's occurring in the Dow. And then you go to the IWM, which is easier to pick because it's so rate sensitive. You watch what's going on in rates, and that gives you a rough idea of what the IWM is going to do, the small caps. And I've talked about this numerous times as well. Why is the IWM, why is the Russell so rate sensitive? Because they're smaller companies. They need to borrow money. And when money's cheaper to borrow, they tend to borrow more. And then they can grow and expand in their business. When rates are higher, they resist borrowing in higher rates. And that means that they're probably going to have slower growth. So that's reflected in the ETF, the IWM for the Russell. So with rates going down, we've had a move up in the Russell, the IWM. So we're at the midpoint of the tap box here as well, and just right at 100% extension. So we have two markets, the S&P and the Qs in wave 3s, and we have two markets, the Dow and the IWM. So we've got the two opposite ends of the spectrum, right? The Dow is viewed as being the more defensive sectors, the 30 biggest companies. They don't tend to react as much to the day-to-day news and noise that comes out, not as quick to react to economic woes, etc., or economic exuberance. Either way, it tends not to react as much. But then you have the IWM that could be very volatile depending on what happens in rates. And then the two midpoints are the Qs and the SPY, especially now when we all know that just a couple handfuls of stocks have been the primary drivers of the Dow with those two letters AI in there. What happens? Normally, the markets don't stay separated like this for long. Again, the patterns don't have to be exactly the same, but you've got the Dow and the IWM saying, you know what, we might be ripe for a wave correction down to the previous wave four. And then you have the Qs and the SPY that are saying, we could even go higher from here before we get to wave four correction. Or if we do get a correction, it'll probably be more shallow. So, yeah, it's a difficult time right now from a technical standpoint. And what will normally happen is this, I call it discombobulation between the labeling and the markets, doesn't last for long. Eventually, they'll come back in sync, and we'll have roughly the same Elliott Wave pattern on all of them, which means two of them have to relabel. So do the Qs and the SPY relabel to a wave five on a corrective move and say, no, that wasn't a three, we're in a five and now we're correcting? Or do we get the FOMO? Do we get the move higher on perhaps a 50 basis point rate cut? And then we get the Dow and the IWM to have those wave fives relabeled to a three. I think it's going to be fascinating over the next couple of weeks to see how that plays out. But I think there will be a time a few weeks from now when we look at these four primary markets and they all have the same Elliott Wave count. Again, this discombobulation or separation doesn't normally last long. It happens. It happens a lot. It's not that unusual to see it. It's just it doesn't last that way very long. So I hope I made that point clear. Now let's take a look at the metals. And gold also following along with the bond market. Usually moves with the dollar, but the dollar's just been hovering in the low end and hasn't really broken down below that 97.5 level. But gold has been trading like the dollar is going to be coming down. So is gold right? Is the Fed going to cut more than expected, or at least tell us, even if they only go 25 basis points, if they hint towards there could be two more cuts coming by the end of the year, I think the market handles that okay. But short of that, we could see a big reversal in gold because right now it's following along with what the bond market is saying, and it normally moves along with what the dollar is doing. We know we had this big triangle. I've talked about this a lot in our volatility portfolio, where we have these triangles, and GLD has been one of my favorite symbols for that because it does this a lot. It consolidates, breaks out, consolidates, breaks out. GLD does it all the time and has for, again, decades. And we had it again. And as much as I tried to put a strangle, one of the strategies that kind of made me famous with the options world on these triangles, unique way of doing strangles, it just wouldn't price out right. We just couldn't get one that made sense. So when you're looking at a triangle, according to Elliott, you have to respect both ways. But we picked a direction, and we did that in the speculative portfolio because that's what it was. It was speculation. It wasn't following the rules of a triangle where you're set up to be okay regardless of the direction that it breaks. So when you pick a direction, you're not following the rules of a triangle breakout or a strangle. You're picking a direction which has heightened risk to it. We got it right. We were fortunate to get it right because gold did break higher and the AI came in. We actually took it off here because that's where the triangle said we'd go if we broke to the upside. That's where the triangle said we would go if we broke to the downside. And then right as we took that off, the AI came out and said, no, I think we're going to go a little higher. And the AI was right. We did go a little bit higher. So from Monday morning quarterbacking, you could go back and say, you should have hung on a little longer. You could have made more. It's true. But again, you don't know that going in. It hit our target. That was the triangle targets. The AI came in with something completely different. It's not following triangle rules. It has over 300 data points of its own that the AI calculates. So you could say gosh, we got out a little too soon on these calls, but it was still a great trade. And when you make nearly 100% on a trade in an options trade, you're happy. Don't get greedy. You've heard the whole expression, greed kills, all that kind of stuff. Um, you just you take your profits and you're happy and you're like, oh wow, the AI was right. And if you were a huge believer, as I am in the AI, you could have made a case for staying until that target hit. But look how vertical this move was. That's extra IV in the calls. And then we kind of consolidated. We did go up, but we consolidated a few days before going higher. So a lot of that volatility that was created in the calls on this vertical part of the move was taken out. So depending on what strike you had, you could have done okay from the delta standpoint on this move higher, but you would have lost that IV spike that occurred because of the vertical move. And I like to take those IV spikes. I view that as free money. That's just the market makers pricing in the volatility of the move, getting away from delta, gamma, all the primary Greeks, etc. And I just like to scalp that extra IV when possible, even when you go back and say, oh gosh, it went higher. Maybe we could have done better. But if you go back and look at the calls, you'd say, man, that IV makes a big difference. Even if the stock goes higher, you take all that IV out and you're like, wow, we went from 330 to 337. Those calls should have been worth a lot more, but they weren't because the IV came back out. So that's the key there. And then SLV following suit here with this move up. I've been opining that silver would play a little bit of catch up. It's had this really uniform wave 5 pattern here. We had a corrective triangle in the wave 4. We broke out of it as we moved into the wave 5. We're in the tap box. We're a little separated from the 10-day moving average. Gold and silver have both been following the bond market and pricing in easing monetary policy even more than the dollar has been. And then if we go to the crypto space, and we look at BITB. A lot of you like IBIT. Either one's fine. They both have very liquid options. IBIT does have weekly options if you're wanting to get into that leverage on a very short-term basis. The BITB does not, but they're both Bitcoin ETFs, and we're drifting up. And there's a lot of suspicion that the next big run in crypto from people that know more about it than I do, Zack included, are saying that we have to wait and see what the Fed does. But if they do embark on an easing policy, even if they only go 25 basis points, but hint that there's more coming, that could be the catalyst for the next big run in crypto. So far, we're kind of trending that way, and we've got this big zigzag pattern which shows the BITB going above 70. Maybe that happens. So far, it's marching there. We are above the 10, 30, and 50-day moving averages, so we'll play that out. And then Ethereum, which has been actually performing up till the last few weeks better than Bitcoin. We had this stair-step pattern, old school pattern here, where you go vertically up, consolidate horizontally, go vertically up, consolidate horizontally, you go vertically up. This time we consolidated into a triangle. And we had a little bit of a breakout attempt here on Ethereum, and then we came back to the point of the triangle. And I just, for those of you that might be new, go over the ways that a triangle breaks out one more time. Sometimes when you have a triangle, it breaks out and runs, and that's it. It just breaks out and takes off and runs. Other times it'll break out, come back and test the point of the breakout, and then run. And then the third way is the initial move is a false breakout, a head fake, and the big move actually is to the opposite direction, which I do think could very well happen if the Fed does nothing tomorrow. If they stand pat, I do think you see a corrective move in the crypto space. But if they do as expected, the people, again, that follow crypto even more than I do, feel like it's the catalyst for the next move up. So we'll see. A lot riding on it. Then when we move to energy, we had a tick up on UNG. I've been through this so many times, so I don't want to spend a whole lot of time on it. big move down in natural gas, which has really surprised a lot of people because we know the administration is anti-solar and anti-wind. We know the electrical grid won't power all these data centers that are going to be built in the future, and that energy is going to have to come from somewhere. And a lot of the companies are saying they're going to use natural gas. Well, why hasn't all that created this big, massive run in natural gas? Because we have tons of it. It's the supply demand curve. And even though we know there's going to be increased demand on natural gas, it hasn't been enough, at least not yet, to offset the supply side. We are the Middle East in the US for natural gas. We've got a ton of it. So the supply has been winning out. And I have for our subscribers at evotrader.com, a long position, long calls on UNG, not because I think that the supply demand curve is ready to flip the other way anytime soon. It's just my opinion, and what I've witnessed over nearly 3 decades of doing this is that when you have such an extended move lower, you get to a point where eventually the sellers are exhausted. Even if the supply demand curve hasn't shifted, even if there's not new demands on where the price is going to go, you just simply run out of shorts at some point. And it doesn't take much to move the needle the other direction. It doesn't take that many longs. And that's what I think is going on in natural gas. I thought we'd get to the 50-day moving average. We looked to be heading there last week. We came back down, tested the lows at 12 and a half. We're making another little bit of a run here. And I thought we would break the 50-day moving average and perhaps come up to resistance at 15. So I'm not looking for any sort of a big, massive spike and run in natural gas, just an oversold bounce. That's all. And we'll see if that continues. If I'm right there, that the sellers are exhausted. Maybe a whole new crop comes in and we push that wave 5 lower, but it's already extended over 100%. So we aren't looking for a move all the way back up here to the previous 4. Again, we're just looking for a bounce back to that previous fib level. Oil, a little bit up today, but still, Zach, we got to get a soundbite from Led Zeppelin's song that remains the same. I know you can't do that kind of stuff from copyrights, but we could get a few seconds of it when we have one of these. But that's what it's been with oil for as long as a lot of you have been listening. I've been talking about how I thought oil from the beginning of the year was going to stay in this big trading range throughout all of 2025. And then more recently, since mid-June, we've just been hovering right around 75, which is where I think OPEC wants to see the price of oil stay, and at least as evidenced by the ETF USO, that we stay here around 75. That means that the price is slightly inflated. They're making a little more profits on the amount that they have in the ground. Talked about this before. They know they've done the geological surveys. They know they're running out of oil in the ground. They want to make as much money as they can with what they have left. But they're also very aware and have done, in my opinion, a great job of managing the supply demand curve on their own. Better job than the natural gas people have done of keeping the oil price pinned here. When we started to get what looked like takeoff moves in oil, OPEC came in and increased production. We are in a triangle, so we are going to get some sort of a move here on USO. It could break higher, it could break lower. And what I've been wondering is if we start to break lower and come down towards, and this is very similar to what I drew for the GLD breakout on where we could go. If we start to break down here and we break below 70, how long is it before OPEC flips the script and comes up with a production cut, or rather than the increases in production that they did when we had these 2 spikes? But there's not much else to say about USO. Just say virtually the same thing week in and week out. At that point, Zach, I don't really think we'll do the round the world tour. Kind of been chatting and soapboxing here for a while. I want to allow enough time for questions before we get to this week's case study consideration. So let's just go ahead and open it up to the Q&A, because whatever we show is likely to change in the next few days anyway.
No doubt about that. Let's get into it. As you said, we've got a question here on UPWK from Trade Simple.
UPWK. Upwork. Not a company I'm super familiar with. lower dollar price stock, but above 10, which is important. I've talked about this a lot too, because that means institutions that have not just aggressive growth, but growth as their investment objective can own this stock. The key here, and this is a pretty easy technical read, you can see this huge channel that it's been in going back to November of last year, basically between, was that around 11 and a half? Yeah, and 17 and a half. And we're right up at the upper end of the channel. So can it break above this 17 plus level? And you know how it works. You break a major point of support resistance, break out of a triangle, major moving average, whatever. You don't look for just the first day. That can be a head fake. So you want to see a follow through, a confirmation day. Can we get above this 17 plus level with a follow through day? If so, then this could be really off and running. But it's in danger, Will Robinson land here, because it's right up against all this resistance, and we know where it can come down to in support. It was just there in the beginning of August, down here around 11 and a half. And if that resistance holds, it could be headed back down there while it stays in this big, huge channel. So if you're long this stock, I wouldn't get out yet. I would give it an opportunity to break that level and see if it could really take off and run. If you're looking to get in, it would be more prudent to wait. Don't step in until it tells you. The show me, the Missouri analogy that I use, show me you can break that level, because you'll likely have plenty of room to profit to the upside if the stock can break above 17 and a half. If you're looking for a short, I wouldn't get in there either, because it's above the 10-day moving average. So this is a big watch list stock for me. And see what happens. Do we break below that 10-day moving average? Does resistance hold? And it looks like we're going to trend down towards 11 and a half. Then it's a short. If it can break above 17 and a half, you might have a really good long there. So if you're long now, I would just have fairly tight stops. Give it an opportunity to break that 17 and a half level, and let's see what happens. Maybe we can look at that one again in the next week or two and see exactly what it did. All right, next one.
Next up, we have Palantir, PLTR.
Man, so much chatter about this, not just the stock, but the company as well. So I don't want to get into all that, but just looking at the chart, we do know this company, at least the stock price, is extremely high valuation, but a lot of them are. And that's what happens when you have big, long bull runs, is that you get a lot of companies that are technically overvalued by historical norms, but they can stay overvalued for a while until the correction comes. And right now, we're trending above that 10-day moving average. We came down to 150. We tested that A wave high in this zigzag. We've already hit the extended level. We had a 61.8% B wave correction, which also yields 100% extension. If it breaks that, which it did, you look for the next fib level, which is 161.8. That's what I was talking about. That could possibly happen on the SPY if we get the FOMO reaction tomorrow. And it got slightly above that. Well, it was pretty much done then. The zigzag had not only done its job at the 100% extension, we'd gotten that extra extension to the next big fib level. So it was overbought. It had gone a little vertical. It had gapped up. All the things we talk about, what goes vertically up oftentimes comes vertically back down. But it did a really good job of holding 150. And we're back above the 10, 30, and 50-day moving averages. The 10-day moving average has crossed back above the 30. So from just a purely technical standpoint, if we didn't know how important tomorrow was, you'd say, hey, we can go long here, at least up till we hit that previous wave 5 high, which is really the only point of resistance in the way of this stock. That would be the norm on the reading, but we know that what happens tomorrow can change all of this. But for now, if you're long, again, I would have tight stops, but there is no reason to get out of a long position. And if you wanted to enter one, I think that would be, added risk with the Fed meeting looming tomorrow, but you could make a strong case for, hey, I want to give it a chance to run up there and test that previous wave 5 high. And without any sort of a significant corrective move tomorrow, I think that's highly likely. The other side of the coin would be, all right, what if that's a zigzag to the downside? What if that was just a bounce from this A wave impulse lower? And you can make a case for that. You can see we bounced right back up 61.8% of that A wave move lower, which could give us a potential target on Palantir that does break that 150 level down to 125. That is just as viable as it moving higher. So that's where you have to be um, aware that taking a long position right now is highly speculative. You could come up with technical backing for it, but nonetheless, it's still highly speculative. And if the market does sell off, you could easily see this C wave down materialize. So it could go either way. That's, you know, pick your poison there. You're taking risk either way, but that is a qualified zigzag to the downside, which has to be respected just as much as the 1030 cross to the upside, the fact that we held the A wave high, all those things. So again, you know what, you could make an argument regardless of what your personal viewpoint is on where Palantir goes. You know, I briefly talk about fundamentals because I do think they matter to some extent. I don't think they matter as much as technicals do. My personal opinion from somebody that has been 100% trading both. Traded 100% fundamentals early in my trading career. Then I flip flop and traded 100% technicals. Now I like a blend of both, which I think is the more prudent of paths. Um, but you don't really have the fundamentals on your side here because it's a very high value stock right now. But that doesn't mean it can't go higher.
Very well. Next up, like your thoughts on Boeing. It's had a slight pullback, but has been on an upward trend.
And this will be interesting because this is the kind of stock that if the market with the higher beta names in the queues, the big tech stuff, even bleeding into the SPY a little bit, if they start to take a hit, depending on how the market reacts tomorrow, this is where you could find a bid in a company like Boeing. We know what they've been through. We know all the bad news. We know they have a huge backlog of planes. They've got business for I don't know how many years into the future, and it's more of a defensive name because it's a big ticket item. You know, it's usually big corporations or even countries that are buying the planes. And even though we've had this move down lower here, we're a little bit in no man's land. We're in the area of that previous wave three high. But if we do start to get a corrective move in the SPY and the Qs, et cetera, I think you could see a turn back to the upside on Boeing. I would keep that one very much in mind. The other side of the coin, and it seems like every single chart we've looked at so far, you could make an argument for both ways. I know that's not what people want. They want you to make a call one way or the other, but all I do is analyze the charts that I see and then give the possible outcomes. If the market loves what the Fed does and says tomorrow, Boeing probably comes down here back to 200 as money will go rushing back into the high beta stuff. So, yeah, I'd keep a close eye on that one. But if you're looking for a place to go, if the market does start to correct, I think Boeing would be a good place to be. That'd be a good place to run and hide.
Next up, we have RDNT.
Rednet and nice wave three move. You have to admire that was a pretty darn vertical move. It came out of a long consolidation. This is what Zack and I talk about as the launch pad effect. That when a stock really consolidates sideways from the Space Coast in Florida, both my parents worked in the space program, et cetera. So kind of the analogy there. Oftentimes when you have this real sideways consolidation, boom, you get a blast off move from the launch pad. It's exactly what happened with this stock. And you know, I don't like it when things go vertically because oftentimes they come back down. This one didn't. This one has consolidated that upward move quite strongly, which I think has to be respected. I'd really like to see what the DMI is showing here. That looks pretty constructive as well. So I'm not super familiar with what this company does, but from a technical standpoint, that chart looks pretty good. And what you would want to watch, in my opinion, on any sort of a pullback is can we hold this area just under 70? You can see had the vertical move, it consolidated right there and then started in that nice 45-degree angle, which I like. So could certainly make a case that this could drift higher as well if we weren't in front of a hugely expected Fed meeting tomorrow. I would say this likely goes higher, and it may still do that. I would have to do some research and see exactly what the company does, but it's an impressive consolidation following a vertical move, and even on a pullback, I would be surprised if it breaks that 70 level, because when you see something go vertically like this and it doesn't give a lot of it back, that's usually, let's look at volume. Um, See, volume was increasing here on the move up. So, barring any sort of a significant corrective move in the markets, I think that's a good bullish look there. Again, I would want to do a little more research on the company to see how they would be affected depending on what the market reaction is to the Fed meeting. But just from looking at that chart without any other knowledge, I would stay long that right now.
Back over to the crypto sector. Your thoughts on coin?
Um, well, Coin owned the space, and they got a lot of competition now. Robinhood mainly, and Kraken other places. So they don't own the space anymore. There's lots of competition, and that's what happened here on their earnings. Um, they still are. I don't know, Zach, correct me if I'm wrong. I still think they're number one in the space, but they don't own it like they once did. And I think we have to be careful there. We're at a wave four corrective move, 50%, 55%. So right between a 50 and 61.8% level. It held 300. It is above all the major moving averages. If the crypto people are right and the Fed cuts and crypto takes off, then very easily could see that wave five continue and you see Coinbase move up towards 500. It needs that kind of a move out of crypto, in my opinion, because they do have increased competition across the crypto world. And the stop is pretty easy. As long as it holds above 300, you can be long Coinbase. If it breaks below 300, then you got to be prepared because you're likely coming back down to 250. You can see how it consolidated there and went vertically up. There's nothing to stop a move from 300 down to 250. That would be what could happen if the Fed doesn't cut rates. If they stay hawkish, then I think you see a big draft down in crypto, and I think you see Coinbase follow it. But for now, it looks pretty solid to move higher. Just don't think you're going to get this kind of stuff out of Coinbase, these big vertical moves. I don't think that is likely anymore from the valuation and the increased competition that they have. But the chart for now looks good. We'll see what it looks like at 3 o'clock tomorrow.
Thanks, Rob. We still have lots of outstanding, well thought out questions, but I do see we're at time and still need to get to the case study consideration. So if you want to transition over to that, and we'll go from there.
All right. What we're going to do is we are just going to play defense today. We're going to look at the SPY and we're going to look for a corrective move in the SPY based on the fact that I don't think the Fed shocks the market with an unusual cut. I could be wrong. Even if I am wrong, it's never a bad idea to have protection in your portfolio. So if you've got a lot of long stocks, having some puts on the S&P 500, I think makes sense. So we're gonna go bearish on the SPY, and our target price would be a retracement of this C wave because that's zigzag rules. When a zigzag ends, you retrace the C wave. So that would put our target right here where the B is, which I can give you that exact price because I know you need that, Zach, would be around 646. So even breaking maybe below the 650 level, somewhere between 646 and 650, let's just call it 648, split the difference there, would be our target. And I don't think that is a bad move to do, regardless of what you think the market is going to react to tomorrow. We've had one heck of a run from those April lows, and the market will, even with all the arguments of the amount of money on the sidelines, et cetera, the market will correct at some point in time. And it could come tomorrow afternoon, or we again could see a big spike higher. It's going to be fascinating to watch the markets tomorrow afternoon. That's all I know. But that's what our case study consideration is going to be today. Is put some defense on your portfolio and protect yourself in case of a disappointment or a buy the rumor, sell the news reaction tomorrow from the Fed meeting.
Yes, indeed. Tomorrow will tell all. And I apologize. I am traveling at the moment, so I'm having a bit of bandwidth and latency issues. So if perhaps you want to show the ideas of recent TradeFinder posts, or if we just want to wrap up, totally your call, but we will obviously have the idea posted in full detail right after this session is over. And we encourage you, as always, to interact, vote, whether you agree or disagree. We welcome your opinion, just always being considerate of the community throughout the platform. And again, opposing opinions is what makes markets. If everyone agreed, there would be no trades, no transactions to occur. It would be an all buyers or all sellers market. And obviously that wouldn't work. So again, whether you agree or disagree, we welcome your opinion and love to see the growing interaction. So I'll pass back over to you, Rob, and thanks for another insightful session.
Yeah, no worries. See if I can remember the password here when I have to load it, because I use it on a different computer, but I'll show everyone what you were talking about. And let's see if I get the password right. That doesn't look like enough letters. Nope. So try one more time. If not, then you can go experiment and see. Yeah, I don't know what I put in here.
Yeah, sorry, I didn't mean to put you on the spot there.
No, it's autofill on my other computer. So yeah, I guess I need to go figure out what my password was. But we can go back to just the regular site. So I won't be able to show you the past TradeFinder alerts. I do have it up on my other screen. But you go over here to ideas and you get a good aspect, I think, of how popular the social media aspect has become. We all know what's going on in the social media world right now. Don't need to get into that. But all we ask for, or the Hub organization, by creating the social media aspect of this, is be respectful of other opinions. You mentioned it, Zach. Opposing opinions make markets. If everybody thought the market was going the same direction, there'd be no markets. So it's always interesting to post an idea and see what other people think of it. And people may disagree with you. Just be respectful in your disagreement. Like, oh, I see your point, but I think this is what's likely to happen. And so with that, people can vote whether they agree with you or disagree with you on what could occur. And here was a post on NVTS, and you can see a couple people disagreed with them. And at this point in time, it looks like the disagreeers was right. And you can see their comments here, and you can post charts, etc. It's a wonderful social media aspect in the world of trading. And one other point that I wanted to make, Zach, is because I've gotten this question on the U.S. market update, is the AI signals, or are the AI signals and the Elliott Wave and all the things that you talk about with this wonderful hub software just geared to options? And I just wanted to say, at ewotrader.com, Elliott Wave options, we focus on Elliott Wave. But these are chart patterns, and the AI signals are on charts. And if you're a stock trader and you don't know anything about options or derivatives, or don't even really care to participate in them, that's fine. You still can look at the same charts and get an idea of where the stock, the underlying, might be going, and trade the stock accordingly. We choose to trade options on the stock, but you don't have to. So it all works based on the stock patterns, which I think is a really important um, designation to make here. Important point to make is that all the charts are based on the underlying stock. Then you move into, okay, we think the stock's going here. What option trade, what option strategy works best for that? That's where Ewo Trader comes in. But as far as the software itself, if you're just a stock trader and you don't trade derivatives, works perfectly for that as well. So that gave me an opportunity to further that point because, again, several people have asked about it. A lot of people trade stocks. Not everybody trades options. So, yeah, no, this is not, this has some great option tools. You can get option chains, etc. Down here with the charts. But if you just want to look at the chart from stock trading standpoint, that works perfectly well also. So you can see it has the different months and a W, whether they're weekly options or an M for the monthlies. So you can see it has all the weekly options on the SPY. And then we go down to the 19th, which is the third Friday of September. So that's the monthly option. So you can just click over there and then you can put open interest, volume, which is today. You can do any of the Greeks that you want to do. So there is a great options aspect to the platform. But I just want to be clear that if you don't trade options, you get just as much value from it on the stock side of things. And if you're an options trader, it gives you some really cool additional things, strategies, scanners, all kinds of stuff there as well. So with that, there's not much else to say today, Zach, because we are all waiting for 2 o'clock tomorrow afternoon. And next week, when we're talking, we will have a lot to talk about on how the market reacted. What did the Fed do? What did they say? How did the market react? That's what we'll be covering next week. So it's going to be highly interesting to see. So enjoy the rest of your trading day. I think buckle your seatbelts because whether it's to the upside or the downside, I think we're going to see some volatility tomorrow afternoon and likely both directions throughout the course of tomorrow afternoon and into Thursday. So it's going to be fun to watch. It's kind of the stuff that makes you excited as a trader when you know there's going to be movement, especially in the world of options. The one thing you ask for is volatility as an option trader, and I think we're going to get that. So we'll examine how the market takes whatever the Fed does tomorrow. Have a great rest of your afternoon. Look forward to talking again soon. Take care, everybody.